Hello, we are with Henry Yoshida, co-founder and CEO of Rocket Dollar, a fintech entrepreneur. Has been doing this for years. Henry, thank you for coming on the RazReport today.
Hey, thanks for having me. People
It-
introduce me as fintech entrepreneur. I think of myself probably much longer as a financial advisor, more
It's,
recently fintech.
yeah, that's true. As you got it full on me now. You don't need to do that. Henry's a lot more beautiful than me. So you give us a little bit of your background. And I know it started as a financial advisor, then you got fintech because I know Goldman bought one of your companies. But give us the little story of Henry Yoshida.
Yeah, so I started in the Thundering Herd at Merrill Lynch in the year 2000 because I was going to go to law school, but decided that I wanted to save up a little bit of money and get a job for a little while. And so I started in Merrill Lynch in the financial advisor training program in May of 2000. So it was great timing. I live in a tech-focused town, Austin, Texas, and the internet bubble decided to burst in March of that year. So great time to join the financial services industry. And I did that for 10 years. I had a niche. We can talk about that a little bit later. And spun out in 2010. At that point, I think for 2 years, we were technically in sort of this limbo period where we were owned by Bank of America. So I lovingly referred to it as Merrill of America from 08 to 2010. And then we split out, did an RAA. My team and I, we founded an RAA 2010 to 2015. And then after I sold my stake in that, that's when I started doing fintech. And then now I'm on my second one. You mentioned earlier that the first one, the robo-advisor, was acquired by the Marcus division at Goldman Sachs.
Yep, that was the start of it, right? What was that called?
It was called Honest Dollar. So we had an opportunity to get this great domain name, honestdollar.com, transparent pricing, just a robo-advisor with a set monthly flat fee, regardless of how much you had. And that was the name of that one. And of course, you guys can see it above that my current company is rocketdollar.com too. So I'd had a lot of these dollar denominated domain names from back in the day.
Yeah, I remember when I reached out to Honest Dollar way back for the FinTech Awards, the first or second year, to your co-founder. I found like emails with him. That was that was back in the day. So
yeah,
I remember that. As a kid, were you inspired to get into the financial arena?
So it was actually more high school time. My parents immigrated here in the 70s. So they came in the early 70s. I came about in the late 70s. And, when I was in high school, I kind of realized, and I learned throughout my life, just being the children of immigrants who never went to college, working in the restaurant industry, that the people that tended to get ahead or the people that ran things in the United States were actually people who were really good in knowing the rules. And by virtue of that, that's what led to me wanting to be a lawyer. So the rules meant laws. And I noticed that all politicians knew the rules. And so for me, my parents came into a little bit of money from a distant relative, and for the first time in their life had hired someone, quote unquote, a financial advisor. But that person turned out to be kind of a salesperson for one of these very bad indexed variable annuity products. And I realized that they didn't know the rules. So that's kind of what hurt them. And that's what changed maybe the course of my life, being really geeky about understanding how things work. So just rules and general laws for the United States, and in particular how money moved and how business worked. So that's kind of what changed it. And that was when I was a sophomore in high school.
Got it. Now, you didn't go right into the financial services. I mean, weren't you an intern for Bill Clinton at one point?
I was, yeah. So between my junior and senior year of college, so I went to college, on this sort of wanting to know the rules. So everything I did was geared towards pre-law and going to law school. So I'd already taken the law school admissions test and so forth. So part of that was to go towards internships that were sort of known to be precursors to going into law school. And I was lucky enough as one of the 2 students that year from the University of Texas at Austin, to where I did my undergraduate studies, to qualify or get accepted into what is still a super competitive internship at the White House, in the West Wing of the White House. And at the time, Bill Clinton was president.
Were you just a good student?
I was a really good student, my undergrad days. So, I like going to school. I sort of, I like the college experience. I'd never even lived, outside of the town I grew up in. We didn't have enough money to go on vacations when I was a kid. So to me, college was like a vacation every day.
Got Got it. Got it. Got it. So you loved it. Okay. So that was your.
Yeah.
So you did well. How long were you an intern in the White House?
So I signed up. They go in 3 terms, and they may change that up now, but they do summer, spring, and winter. So to kind of make it worthwhile economically for me, you kind of have to leave school and be there full time. So I applied separately for 2 consecutive sessions, and I did basically the spring and then the summer. So I was there from January through the end of summer,
Got it. Do you like it?
1998. I liked it a lot. So we had a lot of access. And then, I always get asked the question of the timing, since it was the second term for Bill Clinton, that I was in the class immediately following probably the most famous intern in world history, I would say at this point. So we were the class that got a lot of attention, a lot of questions about, how much access, what do we do on a daily basis and so forth. So it was a pretty fun time in life.
One of my regrets back in the day, my dad's friend was a congressman. I could have been a page my junior year of high school or senior year, but I didn't want to leave town because my friends' parents were going to be out of town for a while, and I didn't want to miss that. And instead, I was not a page in Washington, and that's one of my regrets to this day. And I blame my parents for not forcing me to go.
I see.
Yes. So, all right, we're going to get into some good stuff. We will get to back to Rocket Dollar, but one of the things, you as a financial advisor with tons of experience, we were talking when we were at the Ernst & Young Entrepreneur of the Year event in Palm Springs, and we were talking about, some of the things that, some of the secrets behind financial advisors. And a few of the things are, why financial advisors quit, or when they quit. And then how does like the bonus and pay work? Let's start off with why do financial advisors, when is the best time for financial advisors to quit their position and move on to another role?
Yeah, well, and we should back up just real quick too. A lot of people sort of recognize that, hey, you work at a firm like a Merrill Lynch, UBS, Morgan Stanley, so these are wirehouse advisors, but it actually is a good foundational framework for becoming an entrepreneur, because you learn how to basically build your own business. So I think outwardly it's portrayed as being a part of a big team, but inwardly you actually kind of run your own particular practice and business inside, and you have to go raise money or bring in money from clients, and you have to decide what your niche is going to be. So it's a great framework, and that will give you an understanding of what I learned being a wirehouse advisor for 10 years, which is that because you have your business and your clients are for the most part yours, although technically they are owned by the firm you work for, you have the ability to have influence to bring them with you. So because of that, if you're a wirehouse advisor at one firm, you actually get offered bonuses to leave that firm and go join another firm. So let's say going from a UBS or Morgan Stanley or vice versa and so forth. And if you kind of understand your audience does, the general geographic makeup for a lot of these firms and where they're located, they're typically concentrated in a downtown area within the same 5-6 blocks in most major cities in the US. So this is actually just a geographic move of likely only 2 to 3 blocks, but an opportunity for you to monetize a one-time payout to go from one firm to another.
Got it. So I get it. I mean, when you're a financial advisor, you're totally an entrepreneur. I mean, I've never seen, that we sold a majority interest in Benzinga, and I have a whole folder now for all the financial advisors that have reached out to me, and some gifts in the mail that I brought to Benzinga and just hand out. I got like a box from one that was like 8 different things, and I brought it to Benzinga on Friday and just gave out.
Right.
But by the way, that stuff does have an impact, I gotta say, because then I feel guilty. They're sending me stuff and it makes me want to do business with them. I don't know.
Or at least hear out the pitch, right? And what's their niche and what do they bring to the table? And
yes, I shouldn't be such a sponge, but I feel like if someone's gonna hustle, I want to give them the benefit of the doubt. That's what I feel. And this because I know how hard it was to build up Benzinga. And I'll hear out their pitch. It'll open the door. Open the door. Now, auditing emails will not open the door. But if it's something that they did something special, there's this one company that sent me a package, an envelope, calls. I don't even know what he's offering yet, but he's getting close where I'm going to hear his pitch out, even though I have no clue what they do. I'm so confused by it. I want to say the name. It's a financial advisory firm, but it's like they have a different angle. But anyway, so So when is the opportunity, if you're gonna switch jobs and move on, like how does it work? When's the best time to do that? How does it, give us the lowdown, the thing
Sure.
behind the thing, the behind the scenes. Henry Yoshida,
Yeah.
CEO and founder of Honest Dollar was the first one. Now it's Rocket Dollar.
Sure. Yeah. And so the lowdown behind it is that you essentially, depending on what your gross top line revenue is that you generate for the firm, your offer for a particular new firm is actually typically based on that number. So they kind of give you a pretty high percentage of that, anywhere from, let's say, 40% to maybe even 125% of that top line revenue at the place you're currently at.
Wait,
And then they offer
wait.
that to you in the form of a bonus to go to the new firm.
Will you explain that like with real numbers?
Yeah. So, let's say, we'll make it easy. Let's just say that you generate $1 million top line for the firm you work for, and then you're on a payout percentage because you obviously get a lot of services and a lot of infrastructure and a lot of brand recognition provided by the house. So if you generate $1 million top line for the firm, and the people that are getting these offers typically are generating much more than this now, but this is just for the sake of math. That you generate $1 million top line.
$1 million in fees, not in assets under management. $1 million.
Not either one. So remember, there's a formula that's based on what the firm you work for actually knows what you generate in revenue for them. So that could be just overall. That could be the fees that you garner off of your entire client base. That could be, some transactions that you do might generate a one time. Maybe you did a lending product because your parent company has banking products and so forth. So it's just $1 million, and then the payout to the end advisor might be 35 or 40 or 45% of that, depending on what your negotiated structure is. So the bonus to go to the new firm is based on that 1 million. It might be, hey, we'll give you $1 million if you come join our firm, and then if you stay with us for 5 to 7 years, it just kind of becomes forgivable in little chunks. It sort of reverse vests in a way. So if you stay at the new firm through the entire, let's say, 8-year period, then you don't need to pay that upfront cash bonus back. So that's why you typically see, wirehouse advisors go from one firm to another over time.
Got it. So it's very advantageous in that regard. It's very advantageous because if you're there, you can get paid nice. You can get paid nicely to go to another firm. So then what keeps someone at an existing firm? What do existing firms do to give you that carrot to keep you to stay at your existing firm?
Yeah, well, so one of them is that, remember, technically the client base that you develop is owned by that firm. So that's one carrot that unlike an RIA where it's your business and you have the right to take it with you. And some of these wirehouse advisors, a lot of them are transitioning, right? They go different routes. So they work out the math to say, hey, is it better for me to go to a new big name Wall Street brokerage firm and join their wealth management division, or is the math better because I can develop and now I pay for all the infrastructure, and my $1 million in top line revenue, I'll end up netting better than that 35 or 40% if I just get my own office, hire my own staff, and pay my own expenses, for example. So you got two forks there, but the way that the current firms sort of keep you is that's where adjustments might be made in that payout ratio. So instead of 30%, it might be 35. Instead of 35, it might be 40. And that number could be adjusted depending on how many years you've been at your current firm.
Got it. So they give you a higher payout ratio or what have you. And but as you know, people do move around.
People do, but some people don't, right? Because remember, there's the risk that the clients don't come with you, even though, hey, I might think that Raz will come with me if I go from one firm to another. He might say, hey, look, I really like, to have my 19 accounts set up here, trust accounts for my family, my lending, mortgage for my primary residence, mortgage for my vacation home, and so forth. Just too much trouble to switch. Or I like being a part of XYZ firm. Yeah, I wish you the best, but I'm going to try to maybe get interviewed and stick with someone else that's at the firm that you're leaving, and so forth. So that's the risk.
Gotcha. I mean, the way that financial advisors have been getting paid has changed over the years too, right? I mean, it first was broker commissions, and then it was other fees. And now a lot of it's assets under management. Assets under management.
Sure.
Do you think that continues to change or evolve, or what do you think happens, and what do you think is the appropriate way to do it anyways?
Yeah, well, I would tell you right now that remember, you're running your business. So if you had a choice, think about this. If you asked any business owner in any industry, would they rather have unpredictable transactional ebbs and flows where they don't know, they can't model what's going to happen year over year, or they rather have an ongoing income stream that's based on some formula that you can model going forward? They'd probably pick the latter. And so I think the trend in financial services with advisors is going to continue to be that, hey, I want to have this sort of asset based, AKA assets under management, and I want to be able to attach my fee structure for that. So for clients with, I don't know, $0 to $500,000 in assets under management with me, that fee may be 1%. And then for people that hit a break point, 500,000 to 1.5 million, I want to charge 45 basis points and so forth. It's predictable. So I think the trend will continue to be that it's an AUM play and so forth, because more of the products are structured that way too. And at the end of it, Benzinga has an audience of a lot of people in the financial services industry. I think there is a semblance of it's aligning people on the same side of the table a little bit better, right? I get paid more if you give me more money to manage, or if I grow your account over time, versus I get paid one time in a transaction for things I do with some portions of your money.
Yeah, I understand that. I mean, I just invested in an opportunity zone, and they charge per as assets under management, and I'm like, I get the business. I mean, I get the AUM business because I got it negotiated lower, but still for not doing much for me, wiring over.
Well, and it's the same way businesses are valued too, right? So businesses accrue to a higher valuation if it's an ongoing recurring revenue stream versus a transactional, unpredictable, and so forth. So that's why, value companies like Netflix with their monthly subscriptions are maybe valued higher than someone who just kind of sells products with a transactional.
It just seems like there's a lot of margin made in this financial services industry. From you watch golf tournaments, you see the advertisers from Mass Mutual to Citi. It seems like there's a lot of margin to be made. Not to fault margin, that it's great, but with fintech and technology, do some things get done easier, more efficiently? Not as opaquely, I guess.
Yeah, I mean, look, if you can justify the value proposition to support the margins that you garner, then that's fine. And then what you're seeing is margins now switching to newer products and newer asset classes, right? So margins and fees on the exchanges for crypto are much higher than they are on stocks right now.
That's
probably
true.
Akin to what stocks were 30 years ago, and maybe that'll get drilled down. There'll be a race to finding some sort of happy medium in there. But on the advisor side, what we talked about earlier is that I think the bottom line is that, hey, FAs at wirehouse firms are effectively, as I just told everyone, they're building their business. So this is their opportunity, maybe once or twice in a career, to potentially monetize against that business, which is technically a part of the firm they're leaving. And it's just something that's happened. Some people choose to stay. That's why you see their 20, 30-year tenures. But you typically see, these people making a move once or twice in their career.
Got it. Okay. Now, if you're going to leave your financial advisor, Joe Schmo, and you're going to leave your firm, when do people leave? What's the best day? Is there a date, or how should they leave their firm?
So look, at the end of this, the underlying people are the clients, right? And it's the client's money. They choose to hold it or have it managed by a financial advisor, and it belongs to them. So there's actually a set sort of protocol. And when I use the word protocol, there is an actual protocol, which is a methodology that you do not take client information with you. You just basically take very basic publicly available information. So like, name and so forth, and even like address to a certain extent, you could take too, because that is available publicly on property tax records for someone that doesn't obfuscate that they're the owner of their own home. And you present that information typically for the firm that you're leaving on a Friday afternoon, because at this point you've probably already set up infrastructure at the new firm to go to. You walk and you show this to your manager. You give them a list and say, hey, I'm going to be leaving effective now, but there is no 2-week sort of notice period in financial services. It's customer accounts, it's personal information. So you leave, you're going to be leaving that day. You're going to get escorted out that day. And you typically try to do it maybe on a Friday afternoon. And for you to have enough time to contact the clients, which you're able to do, and ask them if they'd be interested in coming with you, but not talking to them about it before, you might give yourself a long weekend to do so. So one of those ones with a Monday holiday, and so forth. So you have a chance to potentially talk to what the advisor would say is my client base, although the firm you're leaving would say that it's their client base.
So you can call on Monday. You can call that weekend. Like if you're leaving the firm, you can still call on them.
You can call that person over the weekend. I mean, they are. So it depends on how you look at it, right? I'm the advisor. I cultivated these relationships. I mean, I view them as my clients. Now, from a technicality perspective, they may be clients of the firm that you're leaving, but you have a right to contact them after you've notified that you're going to leave, not before, and talk to them over that weekend. You're just, I guess, in a way, maybe to be real transparent about it, you're just giving yourself a leg up to communicate with your now former clients to come with you to the new firm.
Got it. And so it's an edge to give you that time before other advisors call on those clients.
Right, because they'll redistribute the client names and the client contact information to the advisors in the firm that you just left to communicate about retaining them.
Got it. Okay. And
Yeah.
so people do it all the time, but they make sure to do it on that 3-week vacation, the 3-day when there's Monday off or whatever.
I think people do it at all different times, but if you're kind of in the know, then you would probably talk to someone like me, like I talked to a senior person who'd done it before, and maybe get some strategies that stay within the rules, but give you the best opportunity to communicate with your clients to see if they want to come with you for that transition.
Got it. So if you're a financial advisor, smart to do. If you're leaving your firm, smart to do it on like before MLK or Labor Day or Memorial Day.
Yeah, one of the ones. You give yourself that extra day to talk to the folks, but you got to be very sensitive. You can't tell people beforehand, because then you've violated the rules already.
Got it.
You can't canvass your clients for several months or weeks before that. Then you're the one violating the rules.
So if you do that, then the client, and then the firm you're leaving could come after you.
They will come after you. Yeah. They'll try to seek, some sort of, hey, you can't contact these people. They're our clients. You're using information that belongs to us on behalf of the client.
Got it.
Contact them.
All right. Now, just going back to compensate, a little bit of compensation. If I am a financial advisor, I don't know. You said RA, but if I'm a financial advisor, I work at, I don't know, Morgan Stanley, and I have AUM 100 million.
Sure.
Do you know approximately what I get paid?
It depends on the makeup of your business. So if your business was developed in sort of positioning, I don't know, structured products or maybe carve outs into private equity and alternatives deals, you're probably making a lot more than you would if you were just your sort of I guess niche with your client base at Morgan Stanley. The hypothetical scenario was that you just put people into managed fund-to-fund portfolios that have underlying ETFs, for example, and you're garnering a 100 basis point fee. So if you say that, they'd be $1 million producer. But if someone did more transactional things into proprietary products and carve outs, they could easily maybe potentially double that or triple it.
So if you're saying
like,
like
100 million,
like for private equity fund, get them into private equity funds, unique assets, that's where you have an opportunity to triple than just putting into mutual funds.
Right. And so the particular example you used, I know about because I maintain accounts, even though I'm qualified just like you, Jason, to probably manage your own money. So the reason why we maintain these accounts is actually so we have maybe access to certain things that we can't get on our own in our own do-it-yourself brokerage discount accounts. But yeah, if you make your business doing one of these sort of carve outs and presenting them to your clients, then that's typically done on a transaction at a higher margin or sort of percentage than if you were just ongoing managing index fund ETFs for a fee.
But if I'm doing index ETFs and I have 100 million under management, my approximate fees for the firm are $1 million, and out of that $1 million, I should expect to get about 6 million in. Out of that $1 million, would I expect to make about 500,000 then?
Probably less. So if you're a $1 million producer, your sort of payout rate could probably be between 30 to 45%. So think 300,000 to 450,000.
Got it. Is $100 million hard to get to?
I think that's a pretty good milestone inside of a wirehouse channel. Yeah, that's probably a pretty good foundational base for you to have a very attractive opportunity to think about running the numbers and seeing if it makes sense if you choose to leave to go become your own RIA. Or, sort of, again, we just talked about that formula, maybe taking $1 million just to make it easy. If you did $1 million top line, taking $1 million bonus to go to a new firm.
Got it. And to get that bonus, do I have to be at that new firm for a certain period of time?
Yeah, so it's a reverse vesting. So back in the day when it was being offered to it in my vintages, it was sort of, hey, you need to stay at the new place for 5 to 10 years, and it's a cliff. Maybe some portion of it every year gets forgiven.
Got it.
In a way, and then it's completely forgiven after 8 years, for example.
Did you ever want to create like your own Morgan Stanley?
So
I know you kind of did with your when you started out. You left and started. I think it was like Your Money or
MY Morris Yoshida Group. So that was my RIA.
Yeah.
But so with our RIA, I would tell you right now that we had no intentions of trying to be this broader platform. It's that we were doing consulting. My particular niche, we didn't talk about this earlier, but since I started in the middle of the internet bubble bursting at Merrill Lynch in the year 2000, it was very hard to develop that traditional, mass affluent and high net worth individual customer base to work with a kid that just talked really fast and had no experience and no family connections here in Austin, Texas. So my niche very early in my career became 401ks and sort of the management and setting up of these retirement plans. And that's what I've stuck with ever since. So I did that for the 10 years at Merrill. My RIA was a 401k consulting focused RIA that we grew to $2.5 billion in assets before I left to do fintech opportunities. So we really just created that RIA as a way to be flexible to do the business that we were already doing. I didn't have plans to try to make it a platform. And I would say in my last startup, I didn't either. The current one, I would probably say that, yes, we're working on developing a very sort of good beachhead focus to attract a mass affluent customer base. And then over time, it would be to expand the product offerings on our platform to essentially make us more and more over time a go-to destination to bring more and more of that investable wallet for customers.
Got it. Is that part of what you're doing now with your company now, or with something else? Is it Rocket Dollar that you're talking about, or something else?
I'm talking about with Rocket Dollar. Yeah. So kind of, after building, my own business within the wirehouse for 10 years, 2000 to 2010, and then taking the leap. So people always think that I've been tagged with this term, and maybe you have too, Jason, like serial entrepreneur. But I like to think that each time I just dipped a different toe or a different limb into the water to kind of learn and experiment. So I did build my own business at Merrill Lynch, but at the end of the day, I never had to worry about servers, IT, rent, insurance, or any of those things. So it was a very sort of Merrill Lynch provided a lot of that infrastructure. Then in an RIA, I did have to learn how to create the firm, go sign a lease, and set up our own 401k plan and so forth. And then of course, but we were using off the shelf systems to run that RIA. Then the next one, Honest Dollar. Now you're having to do it all from scratch, including raising the capital to go build this business and develop the software that you were delivering your product and services through. And then I think now finally, maybe in my fourth go round at it here with Honest Dollar, that I'm really thinking about how do I get the business started in the early days, and how do I become the Fidelity or Morgan Stanley for the mass affluent over time.
Yeah. So
how only took 20 years. So
how are you going to do it?
Well, we're in the early stages of that, but I would say the first thing, what we're working on today at Rocket Dollar is that we have a product that's very focused and very unique, but it tends to have characteristics that we like for our customer base, which is that it attracts a mass affluent, what I call Henrys, the high earners, not rich yet, customer base. And when we get a relationship with that customer, it tends to be very sticky because our product, by virtue of what Rocket Dollar does, allows people to buy illiquid private investments inside of a tax restricted account. So what we in sort of tech and fintech call it is that it's a very sticky customer. So there's a high LTV there and lifetime value because it's not very easy to quit the account and so forth. And that gives me the opportunity over time to develop other services and products that would be attractive to that same consumer demographic that's a current customer.
Got it. And how are you getting these customers to find out about you?
Yeah, so we have a lot of
other than through Benzinga.
Yeah, other than through Benzinga, but that alone covers a lot of it, of course. So nice plug for you guys.
Sure.
But we've decided that in a way, this is a new capability, although it's always existed for many decades, which is to do these private investments using an IRA account. So we recognize that, hey, what we can afford to do is be very conscientious about trying to position ourselves as a credible source for people to get information about this capability, and then simultaneously establishing that based on my background as a 20-year financial advisor, former wirehouse, former RAA, former robo-advisor, founder with an exit, and a CFP all throughout with FINRA licenses, that we have built a software platform that you could do this capability through, and driving people to the site and then making sure that there's a lot of content there for people to learn, and then having affiliate channels to sort of create that top of funnel. So we've been very direct to consumer focused. I think in 2022, we'll work on more, I guess you could say, quote unquote, distribution partnerships with the regular financial services industry. But to date, we're at about $500 million in assets right now. And that's been
how much in assets? Sorry.
A little under $500 million in customer assets. Right
and
now.
Why are we and so at the end of the day, why is the customer putting assets in it right now?
At the end of the day, so right now, I think people have a lot of interest. You and I were talking offline here before doing the recording about, a commercial real estate deal that you were looking at in my neck of the woods down in Texas and so forth. So, what I allow people to do is to say, hey, I worked for 10, 15 years at XYZ corporate company with a 401k. If I can tap into those dollars to be able to make these types of investments on the private side, this is the best of both worlds. I didn't know that I could do this, and I have a really long time horizon and great tax treatment for that money.
So you can do that through a 401k?
Well, you can do it through Rocket Dollar. So we help people unlock these old 401ks or IRAs with us. We're an IRA provider, no different than, let's say, a Fidelity, Schwab, Merrill Lynch, Morgan Stanley. But in our IRAs, our customers are able to do private and alt investments instead of just stock bond mutual funds.
So is the growth for Rocket Dollar going to come through working with firms like employers to use you guys as an option?
I don't think it'll be employers, because I spent a lot of time and I managed billions of dollars in that space. So employer offered 401ks are actually a different, it's a company benefit. So they're not really designed, if you've ever noticed, to try to give you access to any and all investments. They're really there. So while you're working at a particular company, people are able to put away a small portion of their paycheck, get inside of a really good tax treatment account and grow that towards their retirement savings. So really where I come in is I help people access any old 401k. So right now, if you talk to an average 40-year-old, they've probably had 5, 6 jobs in the past. Maybe 3 or 4 of them had corporate 401ks. All of those accounts are now eligible to be rolled to an IRA. You could do that with the regular providers that let you do regular things, or you could roll it to me and you can do the cool private things that you might have been eyeing and learning about from your friends in business context.
Got it. Okay. So that's how it's going to work.
Yeah.
So is a lot of it making people understand that they can do this?
Yeah. It's an awareness thing. I mean, I think that, to be fair, there's been a pretty vested interest in making sure from the existing financial services industry that offers products that are manufactured and or a derivative of public securities to essentially say, hey, you've always been allowed to do something different. We saw some articles earlier this year that people like Peter Thiel and Mitt Romney were investing in private things using an IRA, and they've grown these accounts to 9-figure values. This has always been allowed by the average American person. It's just been difficult to find a provider that makes it easy and online. And that's what my job is, to make it easy online, couple $100 a year, 6-page sign up that takes less than 5 minutes to open an account. And then, although what our customers need to do is you need to go find those private opportunities that make sense for you.
Yep. So I have a dumb question, maybe. Why aren't more companies doing this? Why isn't someone doing Rocket Dollar already?
Yeah. So you've had a lot of these shows in the past that have talked about this, but remember, think about it. The current financial services industry, they call it financial services, but they're also in the financial products industry too. So many of the products they create their monetization strategy is by building a vertical stack on creating products that are built on top of public registered securities. So it doesn't make a lot of sense to cannibalize these revenue streams in the vertical supply chain around these products to then allow their customers to go into products that are completely maybe one-off or private or unregistered.
Got it. And so that, okay. So that is what your point is. Okay. So this could be $1 billion idea.
Well, so the thing is, my goal is I want to see if I can make $1 billion. So the company would need to be worth far more than that. But,
Okay.
you know, when you look at it, the marketplace here, there's about $14 trillion in IRAs, 33 trillion overall in retirement accounts in the US. And if you round it up, you know, 100% of that money is sitting in something that's not private and alt investments, which could be anything from private equity, venture funds, early stage technology, startup angel investments, real estate, crypto, crowdfunding, you name it.
Okay. There's
So I think there's huge potential.
Huge potential. I mean, huge. I'm ready to send my check over right now.
Yeah. Well, you know, it takes about 3 to 5 minutes to open up the account, Jason. We'd love to have you.
Yeah.
As a customer.
I'm going to play with it later. So we're going to do another podcast another time with you, Henry, on more on Rocket Dollar and what you guys have going on. But what I wanted to go over with you today is just secrets behind financial advisors, how they get paid, compensation, how you leave as a financial advisor. You've been in the industry for many years. You've been very successful. And I think, you know, if you're a financial advisor, I think there's things to hear about. If you're a user, if you're a customer financial advisor, I think there's things to learn about. And now you understand why some of those financial advisors leave before that holiday weekend. You understand how they get paid. You understand how incentives work. So we appreciate. Is there anything else we missed in regards to that, Henry?
You know, I think it's that maybe it's good for the audience to recognize that financial advisors, whether they work for their own RIA or work for a big firm, are actually very entrepreneurially oriented. So I don't know that actually the broader American public knows that everyone's building their own book and everyone has their own sort of strategies and niche. Mine became, you know, consulting on retirement plans and tax advantaged accounts that trickle down to IRAs. That's what I made my career on. But someone else may do something completely different. You just got to find your space within these large platforms and organizations, and just recognize that these advisors, some of them may take opportunities to actually monetize their business.
Yeah, and that's being entrepreneurial, and they're
that's right.
Understood. So the last two questions are: what was your, potentially one or last, but what was your worst or first job? Your worst or your first job?
Yeah. So my first job, I worked at a McDonald's that was in Garland, Texas. So that's a kind of a northeast suburb of Texas. And it was a really, really tough job. So, you know, I decided to take my talents to another more locally owned burger joint, fast food right down the street. So I think I lasted for maybe about 6 months at McDonald's, learned what I could in the big thing, kind of analogous maybe to my career, right? Learned first at the really big established organization and then took that information and knowledge and went to smaller places.
How old were you when you did this?
I was 16 years old. So the day I turned 16, I started that job.
So your parents wanted you to have a job?
Actually, no, they didn't want me to have a job. They wanted me to focus on studies, but I wanted to have a job and I wanted to, you know, learn to earn money.
Got it. And so McDonald's is where you end up at.
And back then, you know, kids couldn't just spin up an NFT and make $1.6 million. Like I just read about a 12-year-old that did that.
Yep. It's easy. You just, you know, spin up some servers, right?
I didn't even start on the burgers either. I mean, just so you know, when you start at McDonald's and you're 16, you don't actually start you just start by cleaning the kitchen. You don't actually cook any food. That's a promotion.
Oh, really?
Yeah.
Wow. Okay. That's interesting. And so you learned it all. Okay. And did you hate it? Did you hate it? What was your take on that one?
Yeah, you know, I hated the job, but I guess I respected that there was a process literally for everything at that place. I mean, there was a way to do every little thing at that place. So I now, many years later, prior to today, but I did recognize why this company was one of, you know, the most vaunted brand names in Fortune 100 companies for decades. You understood why.
You understood the systematic nature of building a business.
Of processes and focus, actually, right? I mean, you know, at least in my entire lifetime, McDonald's has never tried to become a fine dining restaurant. and so forth. So we take that to heart here in the business, right? Honest Dollar was very focused in doing what they did. Rocket Dollar was very focused. My RIA was very, very focused. Like we weren't, we didn't even have like, here's the 3 things that we do. We had the one that we were really awesome at.
Yeah, but I would say McDonald's has got into investing in like other businesses. I think they like Chipotle and that, you know what I mean? Like they have diversified.
They spun that out, and
Yes.
they've also tried pizzas and other things over time, but for the most part, they've stayed true, I think, to that customer
No,
base.
I totally agree. I totally agree. I mean, they have, and I think they've stayed true to really, putting out fast food, like delivering it fast. That's the value proposition, like that one core thing. We're going to deliver it fast and affordable. That's it.
That's right.
And
So just, I don't know, maybe back then I wasn't thinking too much about this focus of it. It was just more of a first job to make a little bit of money. But, taught me a lot of things about that. Hey, big companies have to have processes and systems in place for you to be able to do your job in northeast suburb of Texas, just like you would in the northeast part of the United States and around the world at that time.
Yep.
But
no, I hear you.
Taught you about, hey, it's important to work too. I enjoyed the work.
No, I hear you. I mean, that's good. That's good learning. So, all right, we went a little longer. We got Henry Yoshida, co-founder, CEO of Rocket Dollar. It's his new startup, giving the secrets behind financial advisors. There'll be a lot more from him. Read about him on Benzinga. And thank you for coming on the RazReport today.
Thanks a lot. Thanks a lot for having me, Jason.
Appreciate it. You're a lot of information.